the best of Money Matters.
Market View on Money FM 89.3.
That's right, you're tuning in to Money FM 89.3. Time now for Market View with me, Chua Tian Tian, where we take you through how the Singapore stock market closed for the day, the biggest movers, sectors, and of course the companies to watch. But as always, a quick recap of some key movements. Well, Singapore shares were lower with global trade tensions remaining on the top of minds of investors. So the Straits Times Index dipped 0.11% to 3,833 points at about 2:18 p.m. Singapore time, with a value turnover of 754.39 million Sing dollars. Now let's take you through how the Singapore stock market fared today. The STI closed marginally in the red, down 0.04% at 3,836 points. In terms of value turnover, we are looking at 1.29 billion Sing dollars. Gainers outnumbered losers, 338 versus 207. Top advances for today, we've got here Shangri-La Hong Kong dollars, DBS and MSC, and top decliners, we've got here GMH USD, New Incorporation USD, and Jardine Cycle and Carriage. Now, in terms of companies to watch for today, we've got for you Sembcorp Industries, because a deal inked by one of Sembcorp Industries' subsidiaries to import natural gas from Indonesia, that has fallen through after regulatory approval was not obtained. Now, elsewhere from US President Donald Trump threatening to slap a 200% tariff on wine and other alcohol imports from Europe, to Foxconn's latest earnings, we've got more international and corporate headlines in focus. And joining me on the line on a Friday is Benjamin Goh, Head of Research and Investor Education at SIAS. Benjamin, welcome.
Hi, how are you?
Good. And Ben, let's start with the Singapore stock market as usual. How did the STI fare today? Any surprises when it comes down to the biggest movers and the sectors that they lie in?
Well, I guess the biggest surprise for Singapore as well as Asia as a whole was that there was a slight respite from all the recent rating, especially considering last night's U.S. equity performance. And really, there are two narratives happening here. So for Singapore as well as Asia, what was really powering the growth today was the pledge by the Central Bank of China, the People's Bank of China, to use additional monetary tools to support growth as well as to enhance their own domestic consumption. So the market kind of took it as an interest rate cut, and that's always good for equity markets. The second narrative was that, as you pointed out earlier, the U.S. government has apparently averted a shutdown because the Democratic U.S. Senate Minority Leader has pledged to help the Democrats, to help the Republicans, I beg your pardon, push through the budget. Yeah. Now, if you look at sectors today, I think what jumped out was that Singapore REITs did exceptionally well. In the top 5 advances, we have Fraser's Logistics and Commercial, Mapletree Industrial, as well as CapitaLand Integrated Commercial Trust. Again, all these companies do have some exposure to Greater China, so I guess the expectation of interest rate cuts might actually, supported their performance today.
I see. And let's zoom in on some of the companies to watch, Ben. Shares of energy and urban solutions provider Sembcorp, we talked about it earlier, it dropped as much as 4.9% earlier today after a deal inked by one of its subsidiaries to import natural gas from Indonesia fell through. Now, if we look at investors' reactions, how far are they warranted and how significant is this change for Sembcorp in the longer term? Because I understand for the short term, no material impact.
Yeah, sure. So if we zoom out on a macro level, 95% of Singapore's electricity actually comes from imported natural gas, and the majority of that is actually from Indonesia and Malaysia. So if you think about it, we are already importing natural gas from Indonesia. So the deal that fell through is not it's not the first one, right? So it's kind of like an ongoing deal, an additional deal to expand capacity and to kind of lock in the supply for the future. So if you think about it that way, this is not really a game-ending scenario. So it's not as if Singapore is going to run out of electricity anytime soon. And also the strategy for Singapore is to diversify into renewable energy sources such as solar power, as well as other types of renewables. Again, solar power mainly going to be coming from Indonesia, but that is going to be a different deal, a different kind of structure. Now, from the market perspective, a major investment bank, Morgan Stanley, actually issued an overweight call today after the news came out on Sembcorp Industries. with a target price north of $7. Now, the current price is, of course, 5-ish, right? So as you can see, right, the Wall Street or the investment banks, they don't think that this is actually anything significant or anything negative for the company. So the price drop today could simply just be a knee-jerk reaction because the market overall is very skittish. It's kind of a risk-off environment right now.
Okay. And another company to watch today, Ben, is Singpost, given how shareholders voted in favour of the sale of Australian logistics business Fleet Management Holdings yesterday. Now, what would the divestment mean for Singpost then, and how does it fit in the broader scheme of things for Singpost if we look at the earlier saga with its leadership as well?
Well, I think the two items are separate. So the leadership change as well as what they're doing with the Australian business, I think are two slightly different things. So if you look at it from a macro perspective, so Singpost is in the postal and logistics sector, right? That has never, ever been sexy. Come on, I mean, it's not like Apple or NVIDIA, right? So what we're talking about from a business perspective is that this is a sector that requires a very large asset base.
Yeah.
So there's a lot of physical assets, very high use of capital, some of which will be funded by debt, and relatively low margins because obviously nobody wants to pay too much for postage, right? So management of these companies really need to focus on markets that provide the most bang for the buck. Excuse me. So from that perspective, I would probably, I'm guessing that the Australian business probably may not have had such a good return on capital invested. So, it really makes sense to sell it and to redeploy the capital elsewhere. Now, the company itself has said that the sale will raise about Aussie $776 million, and that's going to be used to repay part of their debt load as well as issue a special dividend. So I wouldn't say that this is a dramatic change in the strategy. I think this is a bit like good housekeeping, so just good management.
I see. Now, if you're just tuning in, we're in conversation with Benjamin Goh, Head of Research and Investor Education at SIAS. Well, I do want to take some time with this one, Ben, because across the region, all eyes are on earnings out of iPhone's contract manufacturer Foxconn. It's also known as Hon Hai Precision Industry. Now, if we look at Foxconn's quarterly earnings, it missed estimates because of weak Chinese iPhone sales weighing on the performance, and also the fact that it invested more on AI server production. So, if we were to unpack the numbers, Foxconn reported a 13% fall in net income to 46.3 billion new Taiwanese dollars, around 1.4 billion USD, and that compared with analysts' estimates for net income to come in at 54.4 billion new Taiwanese dollars. So how does this compare against your expectations? How concerned are you about the numbers?
Well, it's a bit of a mixed bag because, as we know, Foxconn or Hon Hai is a contract semicon manufacturer. So the products that they make aren't really there. So it depends on how, popular the products of their clients are. So again, this is, there are two narratives here. So the weak numbers, I think, is more of a reflection of Apple's poor performance, especially in China. And again, if you look at Apple makes premium products. They don't make El Cheapo phones. Yeah. So obviously, in an environment where people are a bit skittish about what's happening in the economy, they may not want to pay top dollar for the, iPhone 16. So that's one, right? So I don't think that really changes the entire AI narrative. So if you look at the other piece of information that came out for Hon Hai, the AI server-related sales for January and February is actually up 25% year-on-year, and largely because of the recent launch of NVIDIA's new Blackwell chip. And again, a totally separate narrative coming out of the U.S. is that the Magnificent Seven, some of the tech giants have already guided previously that their capital expenditure for AI-related hardware for this year is not going to decrease. If anything, it's going to increase. So as you can see, right, it sounds like there's a bifurcation in the tech and electronics market. So for consumer-related tech products like smartphones, not good simply because of, tariff wars and people getting a bit anxious. But if you look at companies continuing to spend on AI-related hardware, still growing very, very strong, simply because the current Blackwell chips simply sold out. You can't get it. Now, there is going to be another game changer, I guess, from the perspective of NVIDIA coming in the second half, because they have a upsize Blackwell Ultra coming in the second half, and I think they could have come up with a better name, but Blackwell Ultra, that could actually perform up to 50% better. So if you think about it, the AI demand as well as anecdotal evidence coming out of the U.S., because of the data centers and energy usage. That's not going to go down. So for companies like TSMC as well as Honhai, I think that is going to be a key growth sector.
So as you mentioned as well, Foxconn did say that its first quarter revenue from consumer electronics likely to grow significantly. Sales from cloud and networking products would grow strongly, but it did not give a numerical guidance, but strong guidance it seems. Foxconn aside, Ben, let's talk about Shein, the fast fashion retailer, if you will. Shein's executive chairman, Donald Tang, said he remains committed to plans to take the fast fashion retailer public, despite, of course, being in the crosshairs of U.S. President Donald Trump's campaign to rebalance global trade. Now, as it seeks to convince investors to back that IPO, Shein is also grappling with Trump's proposal to end that tariff-free imports of small goods from China. So looking at all the parcels, e-commerce parcels, how would you read into Shein's latest comments then?
Well, I think they have a very good business case for an IPO. The main reason for doing an IPO is to raise funds to expand the business. So Shein itself needs funds to expand quickly against its current competitors, which are, I believe, Zara, H&M, as well as Temu. Mm-hmm. So Temu is, of course, homegrown, very platform-based, apart from, versus Zara, so H&M, more like brick and mortar. So they need the funds, right? So now the challenge is that the timing is going to be tricky. So again, there are two narratives here. Yeah. So as you mentioned, if the Trump administration ends tariff-free imports for small goods coming from China, Shein is going to be in a tough spot because their platform sells a lot of relatively, budget goods, right? Yeah. So if you slap on a 25% tariff, then suddenly it's not going to be so cheap anymore, and people might just go elsewhere, right? So the sales may suffer if that happens. But the other perspective is from the perspective of financial markets. Now, if you look at the Chinese stock market, actually the Chinese stock market has been doing not bad compared to what's been happening in the U.S. So you've got the likes of Alibaba and Tencent all going up simply because of the tech market, and that this although it's in China. And also the Chinese government has recently stated that they want to boost consumption, make it one of the key pillars of economic growth rather than to be dependent so much on exports to the U.S. for economic growth. So in that sense, it could be that it makes, it's more prudent to do an IPO sooner rather than later. So don't wait too long because capital markets may do worse later on, and because the momentum from the domestic market as well as the government is there. So that might make sense.
Okay. Now, finally, before we let you go, Ben, we have to talk about the U.S. because U.S. President Donald Trump, he had threatened to slap this 200% tariffs on wine, cognac, and other alcohol imports from Europe. And at the same time, in the U.S., there are signs that U.S. lawmakers will avert a government shutdown, which we talked about earlier. Adding on to that chaos, if you will, the Dodge-directed federal layoffs going on. If we look at things from a bigger picture perspective, what is really the outlook for the U.S. economy, and how should investors then position their portfolios?
Well, a couple of things happening. So in the real economy, the impact of the Dodge directed layoffs are probably going to start showing up in the Q2 GDP numbers. So that's as soon as in the next 2 months or so. And then after that, we also expect that in the second half of this year, we might see a quick rise in the unemployment rate of the U.S. simply because the U.S. government is such a key employer and a lot of layoffs are happening. So that also has got what you call externality, so like knock-on effects. Yeah. So if the U.S. government has got a lot of layoffs, then of course companies which are dependent on U.S. government spending also will be impacted, and they may start laying off people as well. So there's a knock-on effect. So that's one. The second thing is, of course, you have got the tariffs wars, leading to disruption in global supply chains, will probably lead to a higher for longer inflation, so a little bit more sticky. But the base case right now is that we still expect core inflation to moderate later this year to about 2.5%, so slightly down from the current 2.8 or 2.9. So in times of uncertainty like this, the classic response from a financial advisor would be to invest in safe haven assets. So you've got gold, you've got treasury bills, but the horse has already ran out of the barn. If you look at gold prices, it's already up quite a fair bit. Today's gold futures price is currently at $3,000 per ounce. You have got the market bulls. They are suggesting that it might actually go all the way to $3,500 per ounce in about 6 months, in about 3 quarters. The other view, and of course this is, to preface my response, right? This is not financial advice, but U.S. equities are down 10% already, right? So you have some companies that are actually quite compelling at the current prices versus the intrinsic value. So for the more adventurous investors, you might want to start consider nibbling.
I see. Thanks so much for the insights, Ben. That was Benjamin Goh, Head of Research and Investor Education at SIAS. Thank you so much for joining us on Money FM 89.3.
Before acting on the information on Money FM, please consider if it's suitable for your own investment objectives, financial situation, and risk tolerance.